Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager for Fundstrat's U.S. Large Cap Granny Shots ETF. Like last week, I think it's important to focus on the macro because correlations of stocks have increased, and so I just thought I would give you our latest macro thoughts. The first is, I think that there are signs, and I'll explain why, that stocks have shown evidence of a bottom. I think it's a structural low decisively, and it's possibly the low for 2025. Here's a price chart of the S&P over the past week, and as you can see, the S&P was 56.69 before Tariff Liberation Day, fell to a low of 48.35 on April 7th, and has recovered somewhat to around 5,300. And we think that there's still roughly 2 to 3% upside in the near term towards 5,500. Now, the S&P has pulled back, but as you can see, it is moving along this near-term trend line. So again, I wouldn't turn too bearish near term. Stocks fell earlier this week, and this has to do with on April 16th, Wednesday, when Fed Chair Powell spoke at the Economic Club of Chicago. Now, he said something consistent with his last appearance, which was at the NAB Business Writers Forum. He says that the Fed has to be patient here because they just don't know what the effects of tariffs will be on either growth or employment. And until they have an idea what the tariff policy is, the Fed has to be patient. Now, that didn't sit well with the president, who this morning said the Fed is too late and too wrong, and he's citing the ECB, and the ECB is actually making cuts because they view tariffs as a demand shock. But I don't think what Powell said is actually sitting poorly with markets. What I'm highlighting here is that when Fed Chair Powell spoke on Wednesday, long-term interest rates, the 10-year yield actually fell. That's in contrast to his same exact comments that he made at the NABE on April 4th, where yields actually rose. So literally he makes the same comments, but 12 days apart, yields actually fall. I think that's a good sign. More importantly, the VIX did rise on Wednesday to 32, but that's well below the VIX levels that we saw over 50 on April 7th and April 8th when the S&P was at 4,800. What am I trying to get at? I think the stock market is in a better place today than it was when the S&P was at 4,800. Just recall there was a lot of panic, there was a lot of fear, yields were rising. It didn't look like the president was going to budge. Remember the talk from Howard Lutnick about he's not negotiating? Well, things have changed, and that's why I think stocks are in a better place. But there is some significance to the fact that the VIX was at 60 and now is at 31. Let me explain. There's three numbers I want to highlight. The VIX was at 60 on April 7th. And then on April 11th, the VIX closed at 37.56, which is an important level. And then earlier this week, it closed at below 31. Okay. Why is that? Well, there's an old adage that says you buy stocks when the VIX is greater than 50, and good things start to happen when the VIX falls below 30. The VIX above 60 has only happened a handful of times. It happened, of course, this past week. It happened during COVID, and it happened during the GFC. Well, let's look at the GFC. Let's use those three dates or those three levels I marked. The VIX above 60, which was October 2008. The VIX falling below 37.56, which didn't happen until January 09, and the VIX closing below 31. Well, importantly, when you close below 31, you were past the low because the low was March 09. During COVID, the VIX didn't close below 37.56 until March 24th, 2020, and it didn't close below 31 until April 2020, but you were already past the low. That's why I think it's important to consider that some important structural low took place this past week. Okay, so I think that we're still in a bull market. I'm just not clear if it's a V-shaped recovery like 2020 or it's a range market like 2011. Intuitively, I'm going to say that it makes sense that we made a bottom, but we're maybe range bound for a bit. And that's because people are worried that there's other shoes to drop. I mean, the tariff war with China could turn into a Cold War. Investors are going to worry about the ripple effects from this shock leading to a global recession. These are extreme views, by the way, that some people are going to worry about a financial crisis from all this deleveraging. And inflation expectations could surge to an extent that we get greedflation. Remember, that's like companies basically raising prices, and it's going to force the Fed to hike. And of course, if estimates fall more than 20%, stocks have downside because the stock market already had a 20% drawdown. But the internal low seems to have been in place. This is the percentage of stocks above the 50-day moving average at the top and above the 200-day moving average on the bottom. Below 20% is a big deal because over the last 16 years, the S&P was higher 6 months and 12 months later. In fact, if you look at 3 months later, outside of 2022, the stock market was higher 3 months later every single time. So I think we did make a structural low. Now, the second thing to keep in mind is the macro is going to be messy for a couple of obvious reasons. We just don't know what the tariff policy is going to be, and we just don't know what the economic ripples are going to be. Polymarket says the market is only expecting a 37% chance of a China-US trade deal before June. That's not great. Be great to see this above 50%. The odds of a recession, according to Polymarket, betting is 53%. That's not great, but it's definitely better than 68%, which is where it was a week ago. And I think I'm encouraged by the fact that high yield has rallied almost 50 basis points from a week ago. That's a pretty significant move from 461 to 414. So I think it's helpful to look at things on the margin. So are things getting less bad or better? It's like a relative thing. And I'd say that the relative news has been good. This is a Truth Social post from the president this morning. He says he had a productive call with the president of Mexico, and he met with the highest level of Japanese trade representatives, and he's meeting with Italy today. That's great news. And maybe notably, he says every nation, including China, wants to meet. Okay, this is on April 17th. I think that's a positive tweet. And we know that the White House has been moving towards de-escalation. Anyways, from the delaying of the tariffs on April 9th to the CBP actions late Friday last week. And we know there's more voices in the room. You know, we have the Mag 7, the automakers, and Jamie Dimon also having influence on the president and his actions, which is a good thing. Which gets us to the economy. I think the economy's been resilient. I mean, first of all, CEO of Bank of America, Brian Moynihan, said that small businesses, look, they're sitting on their hands, but the asset quality hasn't deteriorated. And he said the consumer is holding up, especially when it comes to services. And I think that's a good sign. We know that there is going to be economic ripples, though, because tourism from abroad to the US is down from Canada to Mexico to Europe and Asia. And United is so unsure about the profit outlook, they had to give 2 earnings scenarios. Okay, bottom line, the macro is messy, but the economy is not unraveling yet. All right, so let's look at granny shots and the themes where relative performance stood out. The strongest is energy and cybersecurity over the past week. That's names like Palantir and GE Vernova and CrowdStrike. And the style tilt. And this is again balanced quarterly, but style tilt had the strongest positive contribution to the granny shots portfolio. And as you can see, it's not a surprise to see the drags coming from names like Caterpillar. But let's talk about stocks that have been taking particular hits in the last couple of days. One of them is NVIDIA, because it fell 10% on Wednesday, and it really hasn't recovered. Now you're wondering, why is NVIDIA getting hit so hard? Well, it has to do with an export restriction. NVIDIA makes this H20 chip, which is designed to sell in a way that was acceptable to the US to export to China. It's actually a fairly important chip for NVIDIA. more than $10 billion of sales. But at the moment, because NVIDIA follows the letter of the law, the US does not want them to ship any more H20 chips to China. Well, Dan Ives put it succinctly. Basically, the White House knows that China needs these NVIDIA chips. This is part of the tariff war. So NVIDIA is caught in the crossfire. Okay, well, you might be wondering, does this mean you should get out of NVIDIA? Analysts have already adjusted their estimates for NVIDIA. And NVIDIA trades, okay, it's 18 times year ahead earnings, year plus 2. The semiconductor group trades closer to 26 times. I mean, even a stock like Intel trades at 14 times. NVIDIA is trading as if it doesn't grow. I mean, it's trading below a market multiple. Would I be selling NVIDIA here? No. Does this sound like an opportunity to be adding? I would say so. So to me, at the end of the day, there's only one company that makes chips that are important to AI, and that's NVIDIA. And as you can see, NVIDIA was washed out. It fell to $87 on April 7th. I mean, even now at 100, it's still almost 20% above that level. Okay. Another company that's reporting earnings next week that's a granny shots is Tesla. Now, as you know, Tesla's been taking a lot of hits, partly because of Elon Musk's role at the White House and Doge, and we know it's been hitting demand. But Tesla has responded positively in 3 of the last 4 earnings reports. So as much as dire expectations have come into play, I do think Tesla is pretty washed out. And again, it fell to 214 on April 7th, which I think is a washed out level. It's at 240 right now. So I think a lot of bad news got priced into Tesla. And the last stock I want to point out that looks really washed out is MicroStrategy. The reason I'm pointing this one out in MicroStrategy, for those who are not as familiar with the name, they are a levered Bitcoin equity. They're levered to Bitcoin because they are using Bitcoin as a treasury strategy. Bitcoin itself has acted relatively better recently, so it's starting to improve. But as you can see, MicroStrategy fell to 231 on March 11th. And then on the panic day of April 8th, when everything in the stock market was selling off, MicroStrategy fell to 236. That means it actually held at a higher low on a day when the entire market was crashing. So again, I think MicroStrategy is showing signs of being really washed out.